This segment sponsored by Foster Financial. Welcome to Money Monday, where we provide you with holistic financial advice from Foster Financial. And joining me today is their Vice President, Caleb Doan. Good morning, Caleb.
Good morning.
Welcome back.
Thanks very much.
Yes. Okay. So we're going to talk about something that's really interesting if people want to dabble a bit in investing, but in particular, if they are high earners. So what is that all about?
Yeah. So of course the government likes to put lots of rules on the accounts that you can contribute to. And for kind of your everyday investor, a lot of times those limitations that they put on there might not be too limiting, right? So I mean, if you're making $100,000 and contributing, 15% to your 401k, that's $15,000 a year.
Okay.
Well, the limit in 2025 is $23,500, and so you're relatively below that. You're not really feeling the hurt of that limit at all. But if you're somebody who's a high earner, a doctor, a lawyer, a business owner, a dentist, whatever it might be, you might only be able to contribute 5 or 10% of your earnings into a 401k before you max it out. And so then that limit can obviously hurt you in the long run because you're not able to contribute to some of these tax advantaged accounts.
Okay, yes. So in particular, the tax advantage accounts, not just any investment accounts that's out there, because stocks and bonds, there's no limit to those, correct?
So like an after-tax brokerage account, one that's kind of subject to capital gains tax, that doesn't have a limit on what you can put in, but it doesn't receive the same tax benefits. So that's always kind of the question of trying to get the right money in the right buckets to be able to avoid taxes later on down the road.
Okay, so what can they do? So high earners, what are their options if they're like, okay, I've maxed out on my 401k and other investment accounts?
Yeah, typically what we see is that they'll max out the 401k and then just a bunch of cash starts to build up, right, in their checking or savings account. Maybe they contribute to like an after-tax brokerage account, but a lot of times that cash builds up, and as we all know, if we have cash that builds up, we tend to spend it, right? So a lot of times the money gets spent. When you're a high earner, you have to get a little bit more creative in how to get money in some of these tax-advantaged accounts. And so it can feel a little complex, but obviously that's where we step in. The other accounts that we look at for folks in this situation after maxing out the 401k, we start to contribute to HSAs, we contribute to backdoor Roth accounts, we contribute to 529s for college savings. Maybe we even use a life insurance strategy, or we use one of those after-tax brokerage accounts. But there's kind of a whole tier that we go through to say, all right, if we're maxing out the 401k, here's all the other accounts that we want to contribute to so that we don't end up paying Uncle Sam too much in retirement.
Yeah, that is complex. So how can people really determine if they fall within this category? Some people may say, I'm a high earner, and maybe they're not. So how do they know?
Yeah, well, I mean, a lot of people will know if they're maxing out their 401k already or not. And so if you're in that category, I'd say it's definitely time to start looking at where can we contribute outside of just the 401k. So that's one of the places where we'll step in. And with a lot of these high earners, I mean, time is money, right? And so a lot of times they don't necessarily want to take the time to say, all right, I'm going to do all the research to decide how much I can contribute to these 5 other different accounts that are a little bit more tax advantaged. And that's where we're happy to step in and kind of take that burden off folks, make it simple for you and say, all right, here's the account that you can contribute to. We'll distribute to all these other 5 accounts just to get money in these tax advantaged buckets for you.
Okay, and this is really what is considered when people think about a diverse portfolio in a way, right? It's like you got your assets in different buckets to see what performs best, or is that really referred to something different?
Yeah, no, that's exactly right. I mean, there's diversification of what you're invested in, but there's also a layer of tax diversification too. So I mean, if you have all of your money in a pre-tax 401k, that might be diversified in the investment structure, but if all of your money is pre-tax, you might not be diversified in the tax structure of the investments. And the issue that people can run into is that they get hit with required minimum distributions down the road. And so sometimes we like to say, okay, let's contribute some pre-tax, let's do some Roth, let's do some after-tax. There are many different areas that we can contribute to make sure we save you the most in taxes.
Yeah. And do you find that there's a misconception sometimes when people are not high earners that they're like, you know what, I don't have enough money, enough disposable taxable income coming in to really invest anything.
Right. Yeah.
What
yeah.
do
We,
you see?
yeah, we certainly see that. But I mean, the cool thing around Fort Wayne is that there's a lot of folks that are making $40,000, $50,000, $60,000 a year, and they've just been diligent about contributing to their investment accounts since they started working back when they were 25. And I mean, they have $2, $3, $4 million investment accounts by the time that they retire, just because they've been diligent about it. So,
that's good advice there. Be diligent.
Yeah, absolutely. I mean, the earlier that you can start, the better, but it's also never too late. Yeah. So if you're somebody who's 30, 40 years old and you say, I haven't started yet, it's all right. As long as you get started now, there's still plenty of time for it to compound and grow.
All right. Thank you, Caleb.
Yeah,
thank you. Make me think about that song, Never Too Late, Never Too Late, Never Too
exactly.
Late. It is never too late to start investing. And the best place to start is with Foster Financial, because they will walk you through it all. We'll have their website and phone number listed below, and I'll see you after the break. This segment sponsored by Foster Financial.